Welcome to the deep dive. This is where you send us your sources, articles, notes, whatever you've got, and we jump right in.
Yep, we unpack the key info, try to connect the dots for you.
Exactly. Help you get informed fast, maybe find some surprising things along the way.
Make sense of the noise, basically.
And today we've got a really interesting stack. It's all about global markets, bond markets, trade, big shifts in Asia, that kind of thing.
Yeah, it's pretty wide-ranging. We're talking U.S. fiscal stuff, what's happening with Japanese bonds, emerging markets.
Even touches on politics influencing where people are moving.
Right, so our mission here is to cut through that complexity, show you the connections, and, figure out what it all means for the big picture you're watching.
Okay, let's dive in. Where do we start with this stack?
Well, the sources kick off with the U.S. and a phrase that's apparently doing the rounds among fund managers. Taco.
Taco? Like the food? Surely not.
No, not the food. It stands for, according to an FT columnist mentioned here, Trump always chickens out. Okay, that's blunt. What's the context? How are investors using that?
It seems to capture this expectation about his tariff policies. Big threats initially.
Right, like the recent European one, 50% tariffs threatened.
Exactly. That's the prime example the sources give. Threatened 50% last Friday, then pretty quickly extend the deadline to July 9th.
So the market expects some kind of, an off-ramp?
Yeah, that's the term used. An off-ramp leading towards something more manageable. Probably a universal tariff around 10%. That seems to be the baseline expectation.
Okay. I did see a U.S. court block some of his global tariffs recently, though. Does that change anything?
The sources mention that, yes, a U.S. Court of International Trade ruling. But interestingly, they don't seem to think it fundamentally alters the political expectation. The focus is still on this negotiation dance towards that potential 10% universal tariff.
Got it. So beyond tariffs, what about the bullish side for equity investors? Tax cuts, deregulation, right? The sources pivot there. That's where the focus seems to be shifting for those looking for upside. They highlight a bill passed by the House last Thursday with a, let's say, memorable name.
Oh, yeah. What's it called?
The One Big Beautiful Bill Act, OBBA.
Co-BBA. Okay. If it's big and beautiful, what's the potential cost? What about the debt?
Yes, the fiscal side. The estimates mentioned, like from the Committee for a Responsible Federal Budget, suggest something like this could add around $3.4 trillion to the federal debt over 10 years.
3.4 trillion. How does that stack up against, say, the revenue from that 10% tariff we were just talking about?
Well, that's the comparison they make. A 10% tariff might bring in, maybe $350 billion a year on current import levels.
So $3.5 trillion over 10 years, roughly the same ballpark as the cost of this one bill.
Pretty much, yeah. It puts the scale into perspective. It's a significant potential fiscal hit.
The sources also mentioned something kind of weird about Elon Musk and DOGE, something about fiscal credibility.
Yeah, that sounds out there, doesn't it?
Yeah.
But apparently this was part of some initial thinking in potential administration circles. Maybe using high-profile figures, crypto hype, to sort of provide cover for big tax cuts.
Seriously.
That's what the sources suggest was floated.
Yeah.
But they're also very clear. Whatever that plan was, it's definitely not happening now. It didn't work.
Okay, good to know that plan's off the table. So if that kind of credibility cover isn't there, where does the market focus shift?
It really puts the spotlight on the long end of the U.S. Treasury market. The argument is, with this kind of potential fiscal expansion, without clear revenue offsets, the cost of long-term government borrowing bond yields becomes the critical pressure point. It's less about the Fed, more about the bond market itself now.
And is there a specific level people are watching, a trigger point where things could get messy?
Yes, they talk about the potential for a bond vigilante revolt.
Yeah.
Investors demanding higher yields because they're worried about fiscal discipline.
Right.
The key level mentioned as a potential trigger, where it could really start to impact other markets, is the 10-year Treasury yield breaking decisively above 5%. That's the line in the sand they seem to be watching.
Interesting. So potential upward pressure on U.S. yields. Meanwhile, switching continents, Japan's bond market has been seeing its own drama. The sources really dig into JGBs.
Oh, absolutely. The sell-off in Japanese government bonds, JGBs, it's been quite persistent. And a recent 40-year bond auction really highlighted the stress.
How so? Was demand weak?
Very weak, yeah. The bid-to-cover ratio, basically, demand versus supply, it fell quite sharply. From 2.92 back in March down to 2.21 in the May auction. The sources note that's the lowest since July 2024, so it's a fairly recent drop-off for these super long bonds.
And who's doing the selling? Foreigners heading for the exit.
Well, that's the interesting part. The sources actually point to domestic institutions, especially life and non-life insurers. They sold a record net amount, 646 billion, of super long JGBs back in March. They got a tiny bit back in April, but that March figure was huge.
Huh. Why would Japanese insurers be selling long bonds? Don't they need them for liability matching?
It seems counterintuitive, right?
Yeah.
But the sources offer a couple of theories they've heard. One is maybe they've largely closed their duration mismatches now, so they just don't need to buy as many long bonds anymore.
Okay.
The other potential reason is worry about mark-to-market losses. Even on bonds, they account for as hold to maturity.
Wait, I thought hold to maturity meant you didn't have to mark them down based on price swings.
Mostly true, but there are apparently exceptions. The sources suggest that if the value drops by more than 50% from what they paid, they might have to mark it down. So if yields keep rising, those old low-coupon bonds could theoretically hit that threshold. It's a potential risk driving some selling, perhaps.
So weak 40-year auction.
Right.
What about other long dates?
The 20-year auction last week also had a really low bid to cover, lowest since August 2012. It got so dicey that the sources mentioned reports of authorities actually trying to sort of nudge institutions to participate in this week's 40-year auction. Shows the pressure they're under.
And is rising inflation the big driver behind all this selling?
Definitely a key factor.
Yeah.
Inflation in Japan is picking up. The Tokyo CPI figures tend to lead the national numbers.
What did the latest data show?
Tokyo core CPI jumped to 3.4% year over year in April, up from 2.4% in March. And the national core figure rose to 2.5% from 3.2%. Pretty significant moves. Everyone's now waiting for the May Tokyo numbers.
How are Japanese bank stocks taking all this? Higher yields are usually good for banks, right?
They've been trading like it is, yeah. The Topix Banks Index is up 33% since early April. The market seems to like the steeper yield curve narrative for bank profits.
But could it be too much of a good thing? Too much volatility?
That's the question the sources raise. If the long end gets too volatile, does that become a negative? We saw 30-year and 40-year yields hit record closing highs recently, 3.18% and 3.69%.
But they came back down a bit after that spike.
They did, yeah. Quite sharply, actually. There were reports the Ministry of Finance might trim issuance of these super long bonds. The 30-year yield dropped 19 basis points. The 40-year fell 23. Shows how sensitive the market is to supply news.
And that sensitivity speaks to the volatility you mentioned.
Exactly. The annualized volatility of the 30-year JGB has, tripled almost, from around 4.3% in early 2022 to nearly 12% recently. That makes managing risk much harder.
And all this has made Japan's yield curve look pretty extreme compared to others.
The steepest in the G7 now, yeah. The 30-year minus 2-year spread is huge, 223 basis points. Compare that to the U.S. at 98, Germany 122, UK 141. That's a big outlier. The 30-10 spread is also much wider.
And what about inflation expectations from surveys? Are they rising too?
They are. The Bank of Japan's Tankan survey shows companies see inflation higher in 1 year and 5 years out. And the market measure, the 10-year break-even rate, hit a record high of 1.77%.
So higher inflation prints, higher expectations. Is the market pricing in more BOJ tightening?
It is. Overnight index swaps are now discounting another 17 basis points of hikes by the end of 2025. That was only 8 basis points just back in early May. So expectations have ramped up quickly.
Japan always gets cited for low debt servicing costs despite the huge debt pile. Is that changing?
Well, their interest payments as a percentage of GDP were still lower than the U.S. in 2024, about 1.3% versus 4.7%. But the sources really stress that this rise in long-term yields is the threat. As they roll over debt, higher long-term borrowing costs will bite eventually.
Okay, this is fascinating. We have potential yield pressure in the U.S., definite stress in Japan. But the sources point out this really striking thing happening between Japan and China's bond yields.
Yes. This is where it gets really interesting. JGB yields are actually getting close to crossing Chinese government bond yields. Because in China, long-term yields are bumping along near all-time lows. It's the complete opposite story.
So Japan yields up, China yields down, and they're meeting in the middle.
Kind of, yeah. Japan's 10-year yield has climbed from under 0.5% in mid-2023 to over 1.5% now. China's 10-year has gone the other way, from maybe 2.66% down to around 1.71%, and it even touched 1.59% back in January. They're converging fast.
Why are China's yields so low? What's driving that?
The sources put it down mainly to the ongoing deflationary pressures within China's economy. But despite that, foreign investors have actually been buying more China bonds recently after a dip last year. Holdings were up to RMB 4.44 trillion in April.
Has China's growth completely flatlined then?
No, actually nominal GDP growth picked up a bit recently, from 4.0% year-over-year in Q2 2024 to 4.6% in Q1 2025. So it's not just pure economic weakness. Those deflationary price trends are a big part of the low yield story.
Right. So connecting this yield convergence, Japan versus China, back to the bigger picture, the sources have a pretty strong view on G7 bonds overall, don't they?
They really do. They keep reiterating their view that G7 government bonds are basically in structural bear markets. And that's why they argue investors should be looking more towards local currency emerging market bonds instead.
And they see this shift, EM bonds beating G7 bonds, as a sign of something bigger, like regime change.
Exactly that. They explicitly call it regime change. And the numbers are pretty stark. The Bloomberg EM Local Currency Bond Index has beaten the G7 Government Bond Index by, get this, 44% in U.S. dollar terms just since March 2020.
Wow, 44% is a massive gap in just over 4
It
years.
really is. And what makes it even more remarkable, as the sources point out, is that this happened while the U.S. dollar was strong for a lot of that time. That kind of outperformance against a strong dollar suggests something fundamental is shifting, about risk, about capital flows.
They mentioned their own model portfolio based on this view. How's that structured and how is it done?
Yeah, they run a global sovereign debt portfolio reflecting this. It started in March 2020 and has apparently outperformed the G7 index by 53% in dollar terms. The holdings are interesting. 15% China, 15% Indonesia, 25% India, 20% Singapore, and 25% Brazil.
Looking at that list, China and Singapore don't have super high yields, so it's not just about yield chasing.
No, definitely not. That's a key point they make. For places like China and Singapore, a big part of the expected return is actually currency appreciation. They have forecasts for the renminbi strengthening significantly against the dollar, maybe to 5 in 5 years, and the Singapore dollar potentially even heading towards parity.
And they connect this idea of Asian currency strength to, like, reversing historical trends.
Yes, exactly. They float the idea that maybe a revaluation in currencies like the Taiwanese dollar and others across Asia could mark the beginning of the end of that whole dynamic set off by the Asian crisis back in the late 90s, which saw massive devaluations. Maybe that decades-long trend is turning.
There was even an anecdote in the sources about trying to publish an article on this.
Right. Apparently, they were asked by a major financial newspaper to write about this Asian currency revaluation theme. They wrote it, but then got asked to rewrite it. Specifically, they were told to add mention of some new U.S.-China deal that had just been announced, and crucially, to take out any reference to Taiwan, Korea, and Japan potentially holding more U.S. treasuries as part of some security arrangement.
And the reason given for the rewrite request.
They were told opinion pieces needed to match reporting on facts, and the very short-term news was that the Trump administration had supposedly backed off that Treasury security link idea. The source writers felt their longer-term currency view was still valid, regardless of the day's news, so they declined to rewrite, and the piece didn't run.
That really highlights the tension between the daily news churn and seeing these bigger, slower-moving shifts, doesn't it?
Absolutely. And they used that story to underline their point. They believe the markets are signaling this real regime change is happening. They point to things like the U.S. dollar selling off during risk-off events this year as proof that, as they put it, Pandora's box has already been opened. The old correlations aren't working like they used to.
Going back to their portfolio, Brazil stands out with that really high yield, almost 14%.
It does. And the point they make there is that in Brazil, you're getting paid for taking on perceived fiscal risk. They contrast that sharply with G7 bonds, where they argue investors are not being adequately compensated for what they see as significant, maybe even greater underlying fiscal risks.
Okay, let's zoom in on a couple of those other portfolio countries, Indonesia and India. The sources suggest U.S. dollar weakness has given their central banks room to cut rates.
That seems to be the case. Starting with Indonesia, inflation there is actually pretty low, 1.95% year-over-year in April. So Bank Indonesia, BI, has started easing again. They cut rates 25 basis points recently, down to 5.5%. That's the second cut this year. And it still leaves the real policy rate minus inflation quite high at 3.55%.
Is the central bank signaling a shift in priorities?
Yeah, the commentary from the BI governor seems to be focusing more on weak growth now, rather than currency stability, which was the big worry last year. That shift supports the view mentioned from a Jefferies partner there, expecting maybe another 50 basis points of cuts by the end of the year.
Why the need for cuts? Is growth really slowing that much?
Well, the sources show Indonesia's nominal growth has decelerated quite a bit over the long term, from 15% back in 2010 down to just 6% expected this year. And more immediately, bank loan growth has slowed sharply, down to under 9% year over year in April, from over 13% a year ago. BI even had to lower its loan growth target.
Didn't they announce a stimulus package recently? Did that help lift sentiment?
They did, but the sources called it pretty underwhelming. It's quite small, only about 0.1% of GDP. And apparently it didn't excite investors much. The Jakarta Stock Index actually fell after it was announced.
What about the government's own finances? Are they okay?
The fiscal deficit is projected at 2.8% of GDP this year. That's a bit higher than budgeted, but still below their 3% legal ceiling. The sources say it's mainly due to revenues coming in weaker than expected. Government revenues were down over 12% in the first 4 months of 2025.
And this fits into a bigger picture of economic stress.
It seems so. The sources mention signs of weaker consumer demand, possibly linked to a shrinking middle class. Using official data based on spending levels, they calculate the middle class has fallen from over 21% of the population in 2019 to just over 17% in 2024. That's a pretty significant drop.
Any other signs of strain?
Yeah, the national savings ratio is also mentioned as being the lowest since 2021, so maybe households are dipping into savings more. All this leads the sources to conclude that animal spirits are distinctly lacking in the economy right now.
But despite all that domestic weakness, Indonesian bonds have done incredibly well.
Paradoxically, yes. The 10-year rupiah bond has absolutely crushed the U.S. 10-year Treasury, outperforming by 87% in dollar terms since April 2020. So the bond market seems very bullish, likely pricing in more rate cuts from BI because of the weak growth and low inflation.
Is there also pressure from imports, especially from China?
Yes, that's highlighted too. Cheaper imports, particularly from China, are putting pressure on local Indonesian companies. Imports from China now make up a record 32.5% of Indonesia's total imports. This is linked in the sources to rising layoffs, with official data showing a big jump in job losses between 2022 and 2024.
Okay, turning to India, is it a similar story there with falling inflation?
The disinflation trend is definitely similar. India's CPI inflation averaged 4.6% last fiscal year, but the April print came in at just 3.2% year over year. That's the lowest since mid-2019.
And how's the market reading that? Bullish.
Very bullish for equities, it seems. The thinking is this gives the Reserve Bank of India, the RBI, plenty of room to cut rates, especially with the current governor seen as more dovish. They've already cut by 50 basis points since he took over.
Are more cuts expected?
Yeah, the Jefferies India forecast mentioned expects another 75 basis points of cuts by the end of this calendar year, 2025. The RBI itself is forecasting inflation averaging around 4% next fiscal year.
And Indian bonds, have they performed well too?
Very well, yes. Similar to Indonesia, the 10-year rupee bond has outperformed the U.S. 10-year Treasury by 51% in dollar terms since April 2020.
And the sources made a pretty striking point about the yield difference between India and the U.S.
They did. They basically said it's no longer unthinkable that India's 10-year bond yield, currently around 6.24%, could actually trade below the U.S. 10-year yield at some point. The spread has collapsed from nearly 600 basis points back in April 2020 down to just 171 basis points now. That's a huge convergence, reflecting a big shift in relative perceptions.
Right, we've covered a lot on the markets and macro. Let's pivot to politics on the ground and how that intersects with economic hopes. Korea's recent election seems like a key example in the sources.
Yeah, it's a really interesting case. Lee Jae-myung won the presidency with just under 50% of the vote. The sources actually see this as a positive development because it provides a government with a clear democratic mandate, which hadn't been the case previously. The market seemed to agree. The Kospi index rallied over 4% after the election.
And the big hope for investors now is this value-up story,
Yes.
corporate reform.
That's definitely the narrative. The hope is that this new government will finally push through meaningful corporate governance reforms to unlock value in Korean companies, which often trade at big discounts, the Korea discount.
How does the ruling Minju Party's stance fit into that? They're generally seen as anti-couple, right?
It's exactly. Their traditional stance against the big family-controlled conglomerates, the K-balls, could actually align pretty well with pushing for better governance and more shareholder rights. They backed a bill before making directors accountable to all shareholders, which passed but got vetoed. President-elect Lee has vowed to push a similar bill through quickly, maybe within weeks of taking office.
Did Lee moderate his tone during the campaign?
Apparently so. The sources note he sounded quite moderate, even compared himself to Bernie Sanders at one point. but was careful not to alienate centrist voters. That likely helped him win.
What about specific reforms that could boost value, like dividend taxes?
That's seen as a key area with potential. Dividend taxes in Korea can be really high, up to 45% marginal rate. The sources think reform here has a decent shot. Why? Well, partly because many Jinju supporters now own stocks and would benefit directly. Plus, Korean companies have the lowest dividend payout ratios in Asia, so encouraging more payouts makes sense for the market overall.
Are they as optimistic about reforming inheritance taxes? That's often cited as a reason cable suppressed dividends.
No, much more skeptical there. The sources see major inheritance tax reform as unlikely. They think it clashes too much with Korea's sort of egalitarian culture. They even mentioned the movie Parasite and the party's base. They recall similar hype back in 2017 that went nowhere. So probably not on that front.
But despite that skepticism, are foreign investors starting to look at Korea again because of this value-up theme?
It seems so, based on what the sources are hearing. There's renewed interest, partly because valuations are still pretty low, even after the recent rally. The Kospi is on about 9.3 times forward earnings, which is still below its historical average.
Have there been any tangible successes yet? Any sectors responding?
Yes, Korean banks are highlighted as a kind of success story already. They were given more freedom on dividends, and their stocks have significantly re-rated. Their price-to-book multiples are up, and the bank index has massively outperformed the Kospi since mid-2023. It shows that policy changes can move the needle.
And the Korean one? Is that part of the story too?
Like the other Asian currencies we talked about, yeah. The won looks extremely cheap on a real effective exchange rate basis, way below its peak levels. So potential for long-term appreciation is seen there as well.
From a U.S. viewpoint, does this new government change the geopolitical stance?
The expectation noted is that this Minju government will likely seek a more balanced path between the U.S. and China, compared to the previous president, who was very strongly pro-American before being impeached. So subtle shifts in the regional dynamics are possible.
Okay, shifting gears quite dramatically now, the sources also touch on how these political and economic climates affect where people physically choose to live.
It's a really interesting angle. They mention reports from the UK about a noticeable number of Americans moving there, specifically referencing, quote, Trump-hating Americans looking for a less polarized environment. And there's data. A record number of Americans, over 1,900, applied for British citizenship in the first quarter of 2025.
Is the UK happy to have them?
You bet they are, because apparently the UK is facing the opposite problem, an escalating stampede of wealthy people leaving the country.
Really? Why are wealthy people leaving the UK?
The main trigger identified in the sources was tax changes made in the October budget. It wasn't just capital gains or income tax hikes. The sources say the real flashpoint was the overhaul of inheritance tax rules, especially for non-domiciled residents.
What exactly changed with the inheritance tax?
Well, according to a Spectator article they cite, the old non-dom status got scrapped from April 6th. Now it's based purely on residence. If you were non-dom, after 4 years you pay UK tax on global income, and after 10 years you pay UK inheritance tax on your worldwide assets, even stuff you owned before you ever moved to the UK. And crucially, existing trusts lost their permanent protection, and the Chancellor even taxed some existing trusts retroactively, which broke a long-standing convention.
Wow, taxing existing trusts retroactively sounds like it would upset a lot of people who had planned based on the old rules.
Exactly. The sources emphasize that was a huge deal.
Yeah.
And the impact seems real. They cite figures suggesting nearly 30,000 millionaires have left the UK since 2016, with London alone losing over 11,000 just last year.
That must have a big impact on tax revenues if that many high earners are leaving.
It really does. The sources point out the top 1% of earners in the UK pay almost 30% of all income tax, and the top 0.1% pay 13%. So when you lose a significant number of those people, it leaves a big hole in the tax base. It's a real fiscal challenge.
Okay, let's loop back to where we started, that U.S.-China relationship and the taco idea. How is Trump said to be reacting to things like that court ruling against tariffs?
Well, the sources suggest that maybe the court decision, combined with that taco narrative getting traction, might have provoked a reaction. They point to recent reports that the Commerce Department tried to ban the export of certain advanced semiconductor design software to China.
Ah, the EDA software. What happened when that news broke?
The stocks of the big U.S. companies that make that software, the EDA firms, they dropped hard and fast, down 10–11% immediately on those reports.
Is restricting that software seen as a smart move in the tech race?
The sources are pretty critical. They call moves like that self-defeating. The argument is, first, it makes getting a broader deal with China harder. And second, It just gives China even more incentive to develop its own EDA tools faster, so they don't need the U.S. technology.
How did China respond officially?
Their Ministry of Commerce put out a statement calling the U.S. actions discriminatory restrictions and basically amounting to an economic war. So the rhetoric is still pretty sharp.
The sources also mentioned a dispute over rare earths. The U.S. complaining China isn't exporting enough.
Yeah. Apparently, the administration complained China didn't speed up rare earth exports like they thought was agreed in Geneva. China's response was basically, we never promised that, and export controls on sensitive materials are normal practice anyway.
What's the source's take on that rare earth spat?
They see it as really highlighting the U.S.'s lack of leverage. Their view is the U.S. needs China's rare earths, probably more than China needs U.S. chips right now. So expecting China to ease up on rare earths when the U.S. is tightening screws on tech exports seems unrealistic to them.
Didn't NVIDIA's CEO Jensen Huang weigh in on the U.S. chip restrictions?
He did, quite publicly. He reportedly called the U.S. chip curbs a failure. He pointed out NVIDIA lost huge market share in China to Huawei, walked away from billions in sales, took massive inventory write-offs, and saw margins hit. His point was, basically, don't underestimate your competitors and the consequences of these policies.
Given all this friction back and forth, do the sources think a U.S.-China deal is still possible at all?
They seem to think the best hope rests on direct personal talks between Trump and Xi, maybe around their birthdays in June. If a breakthrough is going to happen, that's probably where it would come from.
And what might a deal realistically look like from this perspective?
Well, one potential shape could be China makes a big visible investment in the U.S., like maybe that CATL battery plant, giving Trump a political win. And in return, the U.S. lifts the tech export controls, letting China buy the advanced U.S. tech it wants again.
But wouldn't rolling back tech restrictions face huge opposition from the U.S. national security people?
Oh, absolutely. A U-turn like that would face massive pushback from the security lobby. But the sources note Trump isn't necessarily a committed hawk himself, although they also say he can be influenced or, their word, manipulated by that group. So a deal would really depend on Trump making a direct decision to override them and find that off-ramp from the tariff fight.
Was the currency exchange rate discussed in Geneva, even off the record?
Officially, no, it wasn't raised. But the sources just assume it must have come up unofficially. They recall the Treasury Secretary warning China before about not devaluing its currency to offset tariffs.
Would the U.S. push China to just float the renminbi freely?
Highly unlikely, according to the sources. They think Beijing remembers Japan's post-Plaza Accord experience too well, the soaring yen causing huge problems. What's seen as more likely, and it fits with the broader Asian currency trend we discussed, is China agreeing to a gradual strengthening of the renminbi. That would also help China boost its own domestic consumption, which it needs to do.
So bottom line on U.S.-China, a deal is conceivable, but it really hangs on a specific political choice by Trump.
That sums it up pretty well. A path exists if Trump decides to take it and move past the security lobby's objections. That would be the off-ramp.
Okay, one last point. That competitive pressure from Chinese imports we saw hurting Indonesian firms, is that happening elsewhere in ASEAN too?
It definitely seems to be a wider trend, yeah. The sources cite data showing imports from China are hitting record shares of total imports in other big ASEAN economies too. Like Thailand, it's nearly 28%. The Philippines, over 26%. It underscores how integrated the region is with China's economy now, and the competitive challenges that brings for local industries right across Southeast Asia.
Wow. Okay, we have covered a lot of ground in this deep dive.
We really have. From, U.S. tariffs and debt worries hitting bond yields to the intense volatility in Japan's bond market.
Yeah.
And comparing that with China's low yields and this whole idea of regime change favoring emerging market bonds.
Plus the details on Indonesia and India, the political hopes in Korea, even how UK tax policy is causing millionaires to move.
Right. It's all interconnected, isn't it? Policy choices, market reactions, geopolitical shifts, they're all feeding into each other, creating these really complex dynamics, winners and losers popping up all over the place.
It really feels like a period of significant change, these shifting dynamics across so many different markets and regions.
Absolutely. It's reshaping capital flows,
Yeah.
trade, investment strategies, even as we saw where people literally decide to live.
So maybe a final thought for you, the listener, to chew on. As all these policy decisions and economic shifts keep playing out globally, how might this ongoing interplay between rising economic powers, especially in Asia, and the domestic political pressures within countries, how might that fundamentally reshape global markets, capital flows, and even migration patterns in the years ahead?